introduced during 18th century itself. It was started by Bombay Cotton Trade Association. They have started trading of commodity futures during the year of 1875. Thereafter, a number of restrictions into the market. There are a number of the restriction which was imposed by the government. The government is also mainly concentrating on the nationalization concept. What exactly the nationalization concept? Whatever the business is owned by the private people is also taken over by the government. Number of banks, the private sector banks are converted into public sector banks. So there are a number of changes that happen. So there are a kind of a regulation in that particular part, especially which was started during the 1940s, 1950s, 1980s. Still, you can take the kind of the problem which was prevailed in the market. So the huge regulation which was imposed by the government, there are the participation or the investment what mobilized by the market is also considerably low compared to other countries. So they are also giving the importance which was realized only after the new economic policy. The kind of importance are also given to the derivatives. So basically what you all aware, the derivative is a mechanism to reduce the risk. So whenever you enter into a kind of contract, there is a reason behind that. The price of the product or price of that the stock or a securities which will be stable in future. So that is what the reason or the importance that we need to know about the derivatives. So hope you all aware the concept of derivative, which was started with the agricultural field. So farmers are facing a kind of serious problem of price instability because it depends on the requirement in the market. Whenever they are producing the product, if the particular agricultural commodity is less than the expected quantity in the market, there is an increase in agricultural commodity prices. But there is an excess supply by the farmers in the market. The price of the products are steeply down in the market. So in that particular kind of concept, they introduced to manage such kind of price risk, the different hedging instruments are being followed. One of the major instruments which was used to reduce the uncertainty of the price of the commodities that they have introduced the derivatives concept. So the concept of derivative which was introduced in India by the cotton trade associations. So they wants to make the stable price for the cotton product, cotton commodity in the market. Later, after witnessing the importance of derivatives in India during 1999, or it means during 1990s, after that the much importance are given. So hope you all aware with the intervention of Bombay Stock Exchange, National Stock Exchange. So they also encouraged to trade, encouraged to make the derivative products available for the financial securities. So they will be primarily concentrating on the financial securities. They will be primarily concentrating on the financial derivatives, both the stock exchanges, Bombay Stock Exchange and National Stock Exchange. Whereas the commodities, we can take different types of commodities like agricultural commodity or like the bullions you can take. So this will be handled by the separate exchange. We call it as a commodity exchange, multi-commodity exchange. So those the types of the metals, precious metals, objects are also taken care by the commodity exchanges. So that the importance which was brought into the notice. Also during that particular period of time, the National Stock Exchange and the Bombay Stock Exchange also takes the different types of derivatives permitted by the Reserve Bank of India to take the different types of derivatives being traded in the market. So hope you understand that what are the significant contribution that made by them. And what they have, NSE has started long-term, short-term futures, especially for interest futures. So interest derivative, currency derivative, commodity derivatives. or such the kind of innovative the derivative products which are also available in the market during that particular period of time. And NSE has suspended the interest rate future, if you all aware, that the interest rate futures which are suspended during the year 2006. Later, they permitted for trading of long-term interest-bearing contracts that they are entered into that thereafter. Unlike what they have, the currency future contract was introduced. Both NSE, BSE as well as multi-commodity exchange, both are trading the currency futures, currency options, the currency derivatives are being traded from 2008 onwards. From 2008 onwards, the NSE had a larger volume of trade during 2009, and new interest rate future which was introduced during that period of time. It was banned in the year 2006 because of the negligence amount of risk. There is no much amount of return being generated in the interest rate futures. So they are not, the investors are not interested to make such kind of investments into the interest rate future, because you all aware we are going to make investment into government bonds, kind of the securities we are investing, which might provide a kind of considerable rate of return, or it is above the economic rate of return only is being provided, not much return is being provided by that. So they are not interested to buy for the futures, especially for interest rate, but thereafter what the kind of long term, the interest bearing securities or long term the government securities in which the interest rate futures are traded, which was slightly increased the penetration in the market. The investors are investing in the market during the period of time, and it is also witnessed that during the year 2009, the National Stock Exchange, in terms of volume, it is recognized as one of the largest stock exchange for trading of derivatives in the world. So these are the milestones of stock exchanges. Thereafter, after you can take 2009-10, thereafter the market is going on as it is. They are trading interest rate derivatives, currency derivatives, commodity derivatives, those things which are traded in the market, especially for the derivative segment. So hope you all aware what is the concept of derivative. So I just again going for a financial derivative. So hope you know that the meaning of derivative, the basic the types of a derivative, financial derivatives and commodity derivatives, and what is the history of derivatives. So these are the things that we have completed so far. And one more thing that you need to know in further about the financial derivatives, what are the instruments are being traded in the financial derivatives segment, that you need to understand. Okay, so in that particular category of financial derivatives, we can have the futures, forward options, swaps, or the important tools which are included, manage the assets portfolio and the financial risks are to be handled on this. So you can take the financial derivatives or trading of financial securities. So you can take the financial securities, that everything that together comes under this category of financial securities, including of future and option. You can have swaps are also comes under this category. Future, option, and swaps are also comes to this category. Together you can go for an option of go for the financial derivatives. So financial derivatives are trading of financial securities based on the underlying price of those financial security. You can establish the future price. Based on that, you are entering into the current contract. So it is a current contract. At the present contract, financial derivative contract, at present you are entering into the contract. For example, 2nd September you are entering into the contract for purchasing of future asset. For purchasing of future asset, or purchasing of financial derivatives, or purchasing of financial securities. So what are the tools, what are the method in which you can be able to enter into the financial derivatives? It is like a futures, it is like a forward, options, and swaps are the major instruments or the major tool which are being traded in the market. For that, the particular purpose to manage the assets, manage the portfolio, and the financial risks are going to be managed by means of having these instruments. So that is what the base thing. The derivative is a tool which has been used for risk management. Please understand. The derivative is a tool which has been used for risk management. Okay. Second one, the price stability has been ensured by the derivatives. So as how the derivative was helpful to the farmer to stable the commodity prices in the market, similar to this, the financial derivatives are ensuring the price stability for the financial instruments in the market. So it is going to be like a risk-taking or risk management measure we have as a financial derivatives. And like the managing of assets, portfolios, you can take the nowadays after that, after this, the options are traded in Bombay Stock Exchange, National Stock Exchange, currency derivatives are introduced in the market, interest rate derivatives are also accepted in the market. Similar to this, investor can directly enter into the market for buying or selling of financial derivatives possible. Similar to this, the investor can able to enter into such kind of contract through the asset management company. It is like a portfolio. They can be able to make investment into such kind of schemes are going to make investment into the financial derivatives. So there are a number of asset management companies are having their own plan, their own scheme for making investment. So they are not going to invest into the particular specific investment, specific option or a future or a forward or a swaps. They are investing irrespective of that the different class of assets they are investing. They are investing into the bond derivatives. They are investing into equity derivatives. So like the combination, they are going to make investment into the market by the asset management companies. They are introducing such kind of schemes in the market. And it is, of course, it is going to reduce the financial risk in the market. The price stability is ensured. The variation in the stock market will be reduced once we have a derivatives in the market, derivatives in that particular segment. But irreversible, what may happen, the future price may also affect the performance of current market condition, making a kind of stability, making a kind of range in which the current market securities are being traded in the market. But there is one important effects are there with respect to this, the contract, the future contract or the financial derivatives contract. The kind of the settlement period might happen on every month. The last Thursday of every month, the settlement cycles happens for financial derivatives. That also has a significant impact on stock market prices. So the price are being traded in the future market for 110 rupee, but the current market price for the security is 120 rupee. So what might happen, that price level is also has a significant impact to determine the current market price. But majority of the time what we are talking, the current market price of the security which can be based on or which can determine or which can be the underlying asset determine the future price. Which can be the underlying asset determine the future price. It safeguard the kind of mechanism what we have a financial derivatives. We have as a financial derivatives. The price of these financial derivative contracts are depends on the spot price. What is the spot price? Is a current market price. What's the current market price of the underlying asset? The assets which are being traded in the market. The assets are the securities. It may be a currency, it may be a stock, it may be an index in which the rate or in which the points it was available in the current market, which we call it as a spot price. It is a current market price. It is a current market points of the index. Together, what we call it as a current price, in which the underlying assets are being traded in the market. Based on that, the future contract prices will be determined. Future contract prices will be determined. And the cost of carrying asset into the future, the relationship with the spot price or the base thing. So what price in which we are going to bring, or in which we are going to buy this particular asset in future? What would be the rate in which we are going to charge? Likewise, some component what we are going to take into the consideration for formulation of the future price, with the formulation of the future price. Okay. So let's say, for example, it is like the cost what we are going to spend, or cost what we are going to procure this asset to the future, procure this asset to the future, procure the security to the future. Let's say, for example, if 5% additionally I am going to spend for this, the current market price of this particular security is 100 rupees. Current market price of this particular security is 100 rupees. So what relationship might be in future based on the past contract? What will be the relationship? So it might be vary 10 to 15%. So likewise, based on this particular parameter, current market price for the security is 100 rupees. They will be determining as 150 rupees, 15 rupees, 115 rupees for a future price for the next month, future price for the thereafter. So they will be determining on the basis of current market price in which the securities are being traded in the market, especially for that particular underlying asset. So which asset we are going to enter into the contract of buying in the future value, buying it in the future value. Based on that we will determine. So you know that, note that the price, spot price, is a current market price. Underlying asset is a current asset being traded in the market. Underlying asset is a current asset being traded in the market. What is underlying asset? Is a securities, financial securities. The term which includes the interest rates, currency, bonds, debentures, equities, the terminologies which are being included in this, the concept of derivatives, with the concept of derivatives. Okay, so that the cost of carrying that asset, what would be the cost which you are going to spend to bring, procure this particular asset into the future value, and what would be the relationship between the future value and the current market price based on some parameter. We have some financial modeling to establish the price, future price for the assets which are being traded in the current market, the securities which are being traded in the current market. Okay. For example, the future and forward contracts are similar in nature, but their price of the future which may differ. Because that you know that the forward contract is between the private parties, whereas this future contract which took place in the organized stock exchanges, organized derivative exchanges. Simply we can say the organized derivative exchanges. Maybe it may be happen in stock exchange, it may be happens in commodity exchange. So hope you know that. So these are the basic the difference in this the financial derivatives. So hope you know that a forward market or the forward contract, where the contract is executed. Any idea? Where the contract is executed? You know that there are two important types of market which are associated with the derivatives. The markets for derivatives, we are divided it into the over-the-counter market, and we are divided it into the derivatives market. It means the derivative exchanges. In exchange traded, the future contract is executed. What about the forward contract? So in that, the contract is executed. So based on that, we have a kind of mechanism to understand the financial derivatives. Before using any financial derivative instrument for hedging or for the purpose of speculating or for the purpose of arbitrating purpose, the trader or the investor must carefully examine all the important aspects related to them. So here we are using three different terminology in which the financial derivative instruments are being used for the purpose of hedging, for the purpose of speculating, for the purpose of arbitrating. So what is hedging? So the concept of hedging, you all aware, it brings the price stability. So the hedging which is going to make the kind of reducing a kind of risk associated with the particular instrument. So whenever you are enter into the current market contract, also you are entered into the future market contract also. The current market contract you are buying, future market contract you are selling. If anyone, the kind of loss you are bearing, the kind of profit also compensated with your loss. So you might not going to lose anything out of that. So that the concept, what we call it as a hedging. Hedging is protecting, is safeguarding, is reducing the risk associated with the instrument. It's reducing the risk associated with the instrument. Yesterday, there is one particular example where I have worked out, if you are in the position of buyer, if you are in the position of seller, when there is increase in price, where there is reduce in price, how it affects the people. How it affects the people. So similar to this, the hedging is mainly focusing on stability, mainly focusing on reducing the risk. And whereas the speculative, the purpose of speculation is for the purpose in which the kind of the exposure where we are going to take the lower risk to high return can be expected out of the speculation. Expected out of the speculation. So you know the basic difference between the investment and the speculation. In that your investment analysis, portfolio management, in that particular subject itself, you can be understand about the investment and the speculation. Whereas the investor is thinking on that particular part, they are considered to make investment into the company. While I'm going to buy the equity share, as an investor, if I'm buying the equity share, I consider that I'm going to make investment into the company. It means before doing such kind of investment, what I'm doing, I'm going for a kind of fundamental analysis. I'm understanding about the economic condition, I'm understanding about the industry situation, I'm understanding about the company, what they're doing in the market. It means about the financial performance of the company. After analyzing all the parameters, only I'm going to make investment into the market. So such a kind of long process, I'm going to make investment for a longer period of time into the market. But the speculator is not bothered about that. Speculator is not going to make investment into the market for a longer period of time. Whereas the speculator is going to make investment for shorter period of time. Let's say, for example, the speculator investing for a few days. Speculator is investing for a few weeks. They are going to make investment. They are going to trade in the market. Speculator are like they are trading in the market. What purpose the speculator is trading? Whereas the investor, what happened? Investor is expecting the moderate level of risk is assumed by the investor. Whereas the speculator, normal course of action, they wants to get the higher rate of risk. They wants to get the higher rate of risk. It is compensated with the return. They are expecting the higher rate of return from the market. So that the basic thing that associated with the speculation or the speculating. And the arbitrating is a difference between the price in which the contracts are executed in the different market segments. In the different market segments. A very simple thing, you can justify or you can get the information. You can take, for example, of ICICI Bank Limited. ICICI Bank Limited is being traded in Bombay Stock Exchange. ICICI Bank Limited is being traded in National Stock Exchange. Also traded in New York Stock Exchange. You can take the benefit of that. For example, if one particular market, the particular share is available for 750 rupees. For example, it is available for NSE, it is available for BSE for 751 rupees. So that the price difference, what we call it as arbitrating price. The price difference in the different market. So what the purpose of this price difference in different market is going to be stabilized by using the financial derivatives. Somewhat investors are buying from one market are going to sell it in another market with a different price. Because of the investor wants to buy certain the kind of asset or a security, and investor is ready to sell the security in the market. Based on that, the price is established for different stock exchanges. So that's the kind of thing what we call it as arbitraging. So the hedging, speculation, arbitration are the main purpose of which is going to be used. The financial derivative is being used. The trader or the investor must carefully examine all the aspects related to them. So there are also two important things that they have given. The trader purely having a motive of speculation. So the trader is primarily concentrating on the technical part of analysis, using previous history of prices, how it is tend to change in the market. For the particular stock is being traded in the market, for the first trading day it was 100 rupees, second trading day it was 110 rupees, third trading day it was 120 rupees, fourth trading day it was 130 rupees. What it is expected on the fifth trading day, automatically what based on the simple average, we can be expected to be 150 rupees. Means fifth trading day, we are expecting at 140 rupees. We are expecting. So there should be a 10 rupee incremental value which might happen over the period of time. We assume that the same trend might be followed. So that the kind of thing what the kind of the trader might have a objective to enter into the market. Whereas the investors are analyzing based on the alternatives only, they are buying and selling of securities in the market. So they are as a trader or as a investors who enter into the market after careful examination of all the aspects related to them, so they will be entering into the financial derivatives contract. Hope you know that there are three different contract or the three months the contract is executed in the market. It is about the current month, near month, and the fair month. These 3 months are applicable for the financial derivatives contract. The term financial derivatives related to the variety of financial instruments. That is what the financial derivatives is the contract you are entering into buying of future financial instrument based on the future price is determined at present based on the current underlying asset, based on the underlying financial instruments in the market. What is underlying financial instruments in the market? Spot price of financial securities, current market price of financial securities in the market. So based on that, the price will be established. And what are the things which are included in the term of financial securities or the financial instruments? That includes stocks, equity shares, bonds, the government securities, everything that together comes under the category. And the treasury bills, money market instruments, it is being traded on behalf of the government by Reserve Bank of India for fulfilling the obligations of the government, short-term obligations of the government. Thereby, the government is issuing the treasury bills in the market. Interest rates, foreign currencies, and other hybrid instruments which are being traded in the market, which has the component of the stocks as well as bonds, likewise preference securities, likewise a kind of instruments which are being traded in the market. That comes under the category of financial derivatives. And the financial derivatives, which includes, there are a different trading or there are a different contract in which the financial derivatives are entered. It is in terms we are defining the futures, forwards, options, and swaps and other category. We are going for that to enter into such kind of contract. The future contracts are the most important form of derivatives. It is organized form in which the market is facilitating for the future contracts. The financial derivative can be derived from the combination of cash market instrument or other financial derivative instruments. Based on that, it will be determined. Not only like the current market price of such instrument or underlying asset is not only taken into the spot price of underlying asset is not only taken. Apart from that, also the future market considerations are also taken. It is like the other financial derivative instruments are also taken. It is like you are going to enter into the contract for buying of Nifty. The current month contract you are entering, you are going to considering about the next month contract and the future fair month contract also you are considering. And also there are different such kind of the contracts are also available in the market. So you are also going to take care of such contracts. So based on that, the price is determined, the future price is determined. The financial market derivatives can be defined as a treasury or capital market instruments which are derived from or bear a close relation with a cash instrument. What is a cash instrument? Cash instrument is a cash market segment. What is cash market segment? It is a current price of financial instruments which are being traded in the market. It is a current price of financial securities which are being traded in the market. It is a spot price of financial securities. It is a spot price of underlying asset. So there are different terminologies we are using, but the base thing or the meaning is very common in nature. Current market price of underlying asset or current market price of securities which are being traded in the market. That is what it is given here as a cash instrument. Okay, or derivative instrument or the future asset which can determine the price of another future asset. Future asset or the future price of the asset which can determine the another price also determined. Hence, the financial derivatives are the financial instruments whose price are derived from the price of other financial instruments or other derivative instruments. The price are to be established in a financial market derivatives. Okay. So these are the basic things related to the financial derivatives. Hope you understand what is financial derivative, what are the contracts are generated in the financial derivatives, and what are the instruments are being traded in the financial derivatives, and how the price of those instruments are identified or established in the market. What purpose the people are going for financial derivatives. Hope you understand the meaning of this. The next one, what we have, the forward contract. So one of the important aspects that you need to know about the forward contract. So how the contracts are created for the financial derivatives. So there are forward contract, future contract, options, swaps, and other types of instruments we have, in which the stocks, indexes, currencies, interest rates are being traded in the market. One thing that you need to understand, when you take the stock exchanges, they have a different segments. They have a different segments of trading. I don't know how many of you understand those segments. Normally, I'm talking about in normally, if you can take National Stock Exchange, they have a cash market segment. They have a future and option market segment, what we renowned as the financial derivatives. They have wholesale debt market segment. Are the major segment which was owned by National Stock Exchange. So what happened to the current market segment? Current market segment or the cash market segment, in which the stocks are lively traded. Stock prices are lively determined. The current price or the present price in which the instruments are being traded in the market. So that the terminology we are using, cash market segment. The cash market segment, what are the instruments are available? It is like what we have. We have even ETFs are also traded in the market. Current market you can able to buy. So ETF, hope you know that. What is ETF? The funds which are being traded in the market. Normally, what the mutual fund you all aware of, you are going to make investment into the mutual fund. The mutual fund company, it means asset management company, is going to invest such kind of investment into various investment avenues. It is going to invest. So likewise, what you have purchased a kind of mutual funds, the primarily you have purchased from the asset management company. If you are going to buy and sell such kind of the instrument, the kind of schemes in a secondary market, we call it as exchange traded fund. How primary market we are purchasing the IPO, initial public offering, further public offering, or we have right issues, preferential allotment, and private placement. How it is being traded in the primary market and how it is available for the secondary market. So the securities which are only being issued in the primary market, which are bought and sold in the market, what we call it as a secondary market. Similar to this, the mutual fund is also being traded in the market. In the secondary market, also the mutual funds are being traded. You can be able to buy, you can be able to sell the such kind of schemes in the market. Specifically, we marked or marked as exchange traded fund. For example, of Gold Bees is one of such schemes which is available in the market. Benchmark exchange traded schemes. So this is why I'm saying that this is just an example that you need to understand about the cash market segment. How it is establishing the price for the current securities, current financial instruments which are being traded in the market, the prices are established. So this is one segment. Another segment what we have, F&O segment, the futures and the option segment, where the future price in which the contracts are created based on the current market price. So hope you know the meaning, what the purpose we are entering into the F&O contract. There are a mechanism behind that to establishing the price, safeguarding the price, everything. The it is like with the motive of hedging, with the motive of speculating, with the motive of arbitrating. the effects which are going to manage the overall risk associated with that for that particular purpose, the F&O segment is working. In F&O segment, the equities, indexes, the currencies, interest rates are traded in the market, But in cash market, you know that there is one particular segment is only being traded. About the current market price, it is only traded. But in F&O segment, you can take the futures and the option segment. It is like the different contracts are created. It's like the future contract or like a forward contract or like option contract. It is like a swaps. But you can take the primarily that forward and swaps are primarily happen in the over-the-counter market. Over-the-counter contracts are created between the private parties. It is created. Whereas you can take the financial derivatives or the financial markets or the future and options are primarily traded in the exchange traded option, or it is a exchange derivatives. Derivative exchange, the contracts are executed. Or stock exchanges, the contracts are executed. Or the stock exchanges, the contracts are executed. Okay, so this is the second segment. Also, in that the F&O, not only that the equities, indexes, it is like currencies or interest rate, also the bonds, the kind of the money market instruments, which are also traded in the F&O segment. In the F&O segment, what we have primarily in the stock exchanges, we have two important types of contract: the future contract and option contract, in which those underlying or the future securities are available in the market. Future securities are available in the market. Wholesale market segment is entirely different, like institutional investors are participating in such kind of this segment. Okay, so this is about why I'm giving. You need to know that how the markets are there, how the prices or the kind of contracts are created in the market. In the market, in this is a stock market, the stock exchanges, how those contracts are created. But we are studying about the derivatives. We are not only going to study about, or not only going to understand about the conditions of stock market. We are also moving ahead to know that the commodity market also, commodity derivatives also. That is what the reason, what we call it as a derivative exchanges. Derivative exchanges. The derivative exchanges, the concept which includes the stock exchanges, includes the commodity exchanges. That is what the word is given in the book, or in the concept we have, derivative exchanges, because the derivative instrument is being traded. Set of derivative instruments are being traded in the stock exchanges. Set of derivative instruments are being traded in the commodity exchanges. Set of derivative instruments are even being traded in the over-the-counter exchange. Over-the-counter exchange is being traded. Okay, so this is the basic thing that you need to understand about the concept of derivatives. Concept of derivatives. So first, let me enter. So I'll just explain what are the different the types of contract can be created for different instruments are being traded in the market. So the financial derivatives, in which there are different types of contracts are there. What are the types of contracts in financial derivatives? Is a future contract, option contract, is a forward contract, is a swaps contract, and other types of contracts which are created in the financial derivatives market. And what are the instruments in which the contracts are created? What are the instruments in which the contracts are created? The contracts are created for the instruments are like the stocks, debentures, bonds, indexes, currencies, interest rate, and commodities, in which the contracts are created. In which the contracts are created, especially with derivative. If you are talking about the financial derivatives, apart from the currency or commodity, apart from the commodity, remaining things are comes together under the category. But when we are taking the currency into that category, currency is also traded in stock exchanges, also traded in commodity exchanges. Hope in the history itself you understand that how the currencies are being traded, currency derivatives are being traded. So one of the important aspects in the financial derivatives contract, the first type of contract what we have, the forward contract. What we have is a forward contract. Okay, let me take the meaning out of that. What is exactly a forward contract? A forward contract is a customized contract between the two parties. So it is not universally the kind of contracts or simultaneously going to happen. Not like that. Not simultaneously going to happen. But you can take the stock exchanges simultaneously. The different contracts are executed. But it is the forward contract is executed between the two parties. There is a buyer and seller. They meet together. They will specify the asset. What is the nature of asset? What is the price, the spot price of current asset? What would be the future price in which the assets are to be sold in the market? So likewise, the condition they will be enter into such kind of contract, what we call it as a future contract. Okay. On the future date, a future contract can be used for the purpose of speculation or for the purpose of the hedging enter into the contract. Although it is a non-standardized nature, makes it particular apt for hedging, primarily for hedging this type of contract, because the speculative motive, you can be enter into the contract for a few days, contract for few weeks, but it not happen while you are you have to identify the buyer, you have to identify the seller, you have to enter into the contract. So this type of contract is primarily meant for hedging, not we are frequently used it for speculative. So that is what the thing that I have given you the meaning. What is speculation? What is hedging? So the speculation with the motive of earning abnormal rate of return with the given span of time, short span of time, you are going to earn the superior rate of return from the market. So this is not possible while they are entering into the forward contract. The kind of the things may not be possible for the speculators who enter into the market, because the speculator might buy that particular instrument for a day. They would like to sell it in the market. They are like a traders. They want to trade it in the market. They only hold for a few weeks. But this type of forward contract may not be possible, because the kind of thing we are only enter into the private parties. So immediately we are not going to switch over and sell it in the people. The kind of things may not be possible. So what it is primarily for the purpose of hedging. It is price stability, to bring the price stability for such kind of instruments in future. For that the particular purpose, you can be able to enter into the forward contract. Hope you understand. If you have any clarification, please raise the question. Okay. The second one, in a forward contract, the buyer and seller agrees to buy or agrees to sell the underlying asset at the price both agree on at a established future date. So what the contract is exactly the forward contract? The forward contract is executed at present, in which what is the price of current asset or what is the price of spot price of current underlying securities in the market, in which the contract is created. In which the contract is created, asset in which the contract is created. It is assuring that the buyer is give the assurance to the seller to buy certain quantity of asset in future. The future date is specified. Buyer have the option that to execute such kind of contract on or before such expiration period. We call it as the expiration date. Before that, they can be able to execute the contract. They can be able to fulfill the contract. They can be able to execute such kind of contract is also possible. So that is what it is. In a forward contract, the buyer and seller agrees to buy. The seller has asset. The buyer wants to buy the particular asset. So the contract is created. Or like the underlying price, the current market price, both of them are agreed to buy or sell in a future date. They enter into the contract. The price is called the forward price. What the price they enter into such kind of contract, what we call it as a forward price. So what is the difference between the spot price and the forward price? Spot price is a current market price in which the underlying assets are available in the market. In which the underlying assets are available in the market. Whereas the forward price is a future price of the underlying asset. Is agreed price between the parties. Is agreed price between the parties. So what we call it as a forward contract. This price calculated using the spot price and the risk-free rate. So this is a very important thing that you need to understand. The forward contract is having a mechanism to determine the forward price. The forward price is based on the spot price. What is spot price? The current market price of the such securities. Current market price of such instrument or the asset is available in the market, plus or based on the risk-free rate. So the risk-free rate, it was determined. There is a negligence of risk is available in such kind of instruments. Negligence of risk is available in such kind of instruments. Simply, I can say, you all know that we are going to make investment. Whatever the risk you are taking, there should be a return is associated. Whatever the risk you are taking, return is compensated. Okay. So what investor normally wants to get from the market? Investor wants to go for, normally as an investor, I want to expect to take lower risk and want to take the higher return from the market. So this is, of course, normally happens for any investor. But what happened, one particular thing that the investor wants to understand that what would be the return provided by that particular instrument, based on that they are going to make investment. So investor has some parameter. If I'm going to take risk, what would be the return? If I'm not going to take any risk, what would be the return generated by the instrument? If I'm not going to take any risk, what would be the return generated by the particular instrument? I'm not going to take risk means there is a zero risk. That means in that what would be the return is generated. That we call it as a risk-free rate. That we call it as a risk-free rate. Normally, as an investor, if you are going to make investment into the treasury bills or any other money market instruments, you are going to make investment, which considered as a risk-free investments. Risk-free investments. Whatever the return, such type of return generated by the treasury bills, that we consider as a risk-free rate without taking any risk, because such kind of instrument is guaranteed by the government. On behalf of the government, the Reserve Bank is issuing to fulfill the obligations of the government. To fulfill the obligations of the government. So such kind of instrument, what I can take as a risk-free investment. It means zero risk is associated with such kind of instruments, which is traded in the market. It means without taking any risk, I can get the return out of the instrument. So what is the interest rate for the treasury bills? Hope you all are aware, the treasury bills are not having explicit rate of return. The treasury bills are having only the implicit rate of return. What is explicit rate of return? What is implicit rate of return? Explicit rate of return, the rate of interest which is mentioned in the title of the instrument itself, 8% debenture, 10% debenture. The instrument itself entitled to provide such kind of returns. But the treasury bills are having the implicit rate of return. It means the treasury bills are being issued in the market for discount price and redeemed at par rate. The treasury bills which are issued in the market for discount rate and redeemed at par rate. Redeemed at par rate. Okay. So what would be the realized interest rate? What would be the realized interest rate? Say, for example, if realized interest rate is about 4% or 4.5%. So 4.5% is the realized rate of return what I can get out of treasury bills. I can consider without taking any risk, I can be able to generate 4.5% of return. So in spite of that, you're going to make investment into the fixed deposit. The fixed deposit schemes are providing 8% of return. I assume that remaining 3.5% of return is generated for the risk I have taken in the market. For the risk I have taken in the market, for that the remaining percentage of return is generated. So similar to this, the calculation of forward price is based on the current market price or a spot price and the risk-free rate prevailing in the market. So the risk-free rate is calculated on the basis of treasury bills or the government securities which are being available in the market. If the treasury bills or the government securities are being provided 4.5% of return or 4.8% of return or 5.1% of return, so such return are taken into the consideration investor, without taking any risk, the investor can generate the return of 5.1% or 4.8% or 4.6% or 4.5%. They can be able to generate the return. So what would be the percentage of return, or what would be the percentage in which I can fix the price for the future asset? In which I can fix the price for the future asset. So on this particular basis, what it is determined? The future price is determined. The forward price is determined. Future price for the forward contract is determined. Hope you understand. So based on the two important parameters, spot price and the risk-free rate. Risk-free rate is otherwise termed as zero beta. Beta is a measurement of risk. Zero beta means no risk is associated. That is what negligence risk is associated with such kind of instruments. So this is taken for the calculation of forward price. The former refers to an asset assets in the current market price. The risk-free rate is hypothetically the rate of return on the investment, assuming that there is a zero risk. That is what the zero beta. So based on that, what we are going to identify the forward price. For example, I just given one example to understand that how these contracts are created. It is created between the private parties. So between the private parties, how such contracts are created? The forward contracts are created. It is created in the over-the-counter market. It is created as an over-the-counter contract. So here it is given as the Iyengar Bakery enter into a forward contract with the Shakti Sugars Limited. So who do you know? Shakti Sugar Limited, they are manufacturing of sugars, crystallized sugars, chakrin, the different things are available with Shakti Sugars. They are manufacturing the products which are available with them. A sugar manufacturer in Tamil Nadu. For example, in January 1 to 31st of January, they enter into the contract to buy sugar at rupees 30,000 per 1,000 kilogram. It means per kg of sugar, they will accept to buy 30 rupees. Who will accept to buy here? Who is a buyer? Iyengar Baker is a buyer. Who is a seller? Shakti Sugar is a seller. Shakti Sugar is a seller. So the buyer and seller, they agreed to enter into the contract. Contract of what? For purchasing of sugar. Purchasing of sugar from the Shakti Sugar. So for what period they enter into the contract? They enter into the contract for a period of 3 months. From January 1 to 31st of March, they enter into the contract for purchasing of 30,000 rupees. They will be giving for 1,000 kgs of sugar. Irrespective of the market price of sugar, they enter into the contract. They mutually will honor the commitment. So at that particular point of time, say for example, if the Iyengar backers have entered into the contract in the month of December, they can create a kind of contract from January to March and be able to create a kind of contract between the January to March. During the period of time, the 30,000 rupees per 1,000 kg of sugar, it will be given. So the price of sugar, it will be stabilized during that particular period of time. Even though the sugar price is increased or reduced over the period of time, it will not affect the Shakti Sugars. So they will be delivered at the predetermined rate. So this is an example. You can take the Iyengar Bakery, you can take the Shakti Sugar, both are the private parties. They have been identified, they themselves have entered into such kind of contract, what we call it as a forward contract. If it is traded in the market, if it is traded in the stock market, if it is traded in the commodity market, then it is called it as exchange traded derivatives. But otherwise, it is called it as a over-the-counter contracts. It's a forward contract, the type of a forward contract that they have.